Hello and welcome. You're tuned into the Smith Show here on NDTV Profit. I'm Harsh Saita. With me is Mahima Vachajani, and we have the management of Diffusion Engineers with us. It's day one of listing for Diffusion Engineers. We have Abhishek Mehta, who's the CFO, and Prashant Garg, who's the Chairman and Managing Director at Diffusion Engineers. Welcome and many congratulations, sirs.
Feels amazing. Feels thrilled to be here. It's a new start for us.
Right. Just talk to us about what is the next trajectory that we see Diffusion Engineers take. Abhishek, let me come to you.
So we will be doing our expansion. The money which we received, we will be doing our expansion. We will be increasing our capacity in our existing heavy engineering division. We will be doing expansion in our electrodes division also. These are the two things which we are doing with the funds which we have received, and our expansion will starts immediately after, in some time.
Right, Mr. Garg, you're planning to expand your focus beyond cement, steel and power sectors, and you're planning to explore the defense and the mining space. What are your plans with respect to that?
Yes, we are already supplying in the defense sector. Our welding consumables are used for very prestigious application of armoring, which is used in the manufacturing of the T-90 Arjun tank. We are also prominently present in the mining sector. We are supplying to some prominent OEMs such as Metso. So we are already present there, and of course our focus is to diversify new industries. And our capex and expansion will help us cater to newer sectors.
Right. Let me come to you, Abhishek, with regard to how top line shapes up for you. Just talk to us about what's the trajectory you see in the 2 to 3 year period.
So basically it will take around a year or so to do our capex, and then we'll start our production will increase, which will help us increase our top line, and we expect that around will go in the double digits only. That's what our expectation in next 2 to 3 years.
All right, and Abhishek, your margins in FY24 jumped to nearly 14%, which have been around 11% before that. So I want to understand that what has led to this jump, first of all, and do you expect margins to sustain at 14% going forward?
Our margins, because of our lower direct cost, our margins improved, and we expect it to remain in the same level in the years to come. I will try to maintain it in the same level in which it is right now.
All right, and Mr. Mehta, you also plan to begin in-house production for nickel, cobalt and iron-based powders. So this will meet, your raw material demand overall. So I want to understand that how will this impact the overall margins then going forward from a longer-term perspective?
I think Prashant.
I'll take that. So these products are also, they're not used as our raw materials, but they are used for manufacturing products which are supplied in the end customer industry. So this will, and there are very few manufacturers of these products in India, and a majority of these products are imported right now. So it will definitely help us improve margins, because locally manufacturing will reduce cost, and we'll be able to gather or capture bigger market share.
Right. Prashant, let me stick with you. With regard to your capex plans, where does this take your capacity? Just talk to us about where capacity currently stands at. Where does it go maybe a year from now as that capex starts to unwind, and some of that incremental capex that you've built in starts to generate revenue for you?
So currently we are sort of maxed out on our capacities, and that sort of is reflected in the top line of last year. We are already around 85–90% of our utilization. So with this capex, we will be able to double our capacities at least. Of course, what also happens is when you have associated equipments and bigger space, you tend to get better utilization, and even higher manufacturing capacities gets freed up or generated. So we expect minimum double and expect it to be higher also.
Okay, and where does your debt stand? Give us perspective on that, and any more fundraising plans of any kind, or will the entire of any incremental capex from here be funded through internal accruals? Just talk to us about those couple of things.
Yes, so we don't have any long-term debt. We have only got working capital debt going on with us, and we don't expect any new fundraise to happen in the near future. And we think we have strong operating cash flow, so we think that whatever incremental capex will be needed in years to come, we will be able to fund it through our internal accruals.
Right, and Mr. Garg, you're also, particularly focusing on increasing your presence in Turkey. So I want to understand, what is the kind of progress there, and of course, I want to also understand that in terms of, international expansion. Right now, roughly your revenue from international business is 9%. Where will that grow to? Because your focus is to expand internationally.
Yes. So we are typically looking at markets where cement and steel industries are prominently present. It's not just Turkey, so we are also present in Philippines, we are present in Vietnam, and Turkey of course has got a very big cement industry. We are also opened a base in Sharjah, and expect to also start something very soon in Saudi. So we're looking at these sort of geographies because we've got very good credentials and track record in cement and steel sector, and we want to replicate that in these countries. As far as international presence is concerned, I think India, Indian customers have really taught us to develop novel solutions, because the Indian customers demand a maximum out of asset. They want to squeeze the maximum out of their installed base to maximize asset utilization, and that has helped us to develop new products and solutions which we think can be very well replicated in these geographies, and the value realization is also much better in these geographies because the number of players present are less or fewer. So we expect export sales to grow up steadily. Bear in mind that we have grown twice in last 4 years. So as our top line is increasing, the percentage of exports doesn't show up, but our export sales are constantly increasing, and we expect them to at least become 50% to 75% of our total turnover in the near future.
Got it. Just two quick questions on this one, Prashant. So one is, how is competition in some of these markets? You were alluding to the fact that likely competition is not as intense.
In the newer geographies, you mean to say?
Yes, please.
So what I meant to say was our experience in India to serve our customers is helping us to develop newer solutions, and that is helping us to get better, and we can replicate these success stories in these geographies. So that is what I meant to say.
While competition is present there, you believe that just the kind of experience and the kind of work that you've done is helping you penetrate these markets better. Is that the right way to look at it?
Yes,
Okay.
because of our, we are developing newer solutions to, cater to the Indian sector, and these sort of solutions have not been developed to a large extent elsewhere, and then these success stories we are trying to replicate in these newer geographies.
Given that you're maxed out on your capacity utilization, would you therefore focus more on these markets at the expense of India? Is that how your revenue distribution will actually go?
No, our capacities, so with the capex that, with the fundraise that we have been able to do, we will increase our manufacturing capabilities. And
forward, right? Apologies, Mr. Garg, if I'm getting this wrong.
Capabilities or, sorry, come again?
But that's 1 year forward, right? Your capex, the extra amount of capacity that you're adding is maybe a year away. So what do you do for the next year?
No, so it's not that we are selling to these export markets at the cost of Indian markets.
Okay.
right now, as I mentioned before, we are around 85% of our capacity utilization, and there is a lead time that is given to us from our customers to deliver our products and services. So, we are able to cater to these markets. For the growth prospects, we need to increase our capacity so that we can, capture bigger market share in India as well as outside.
Right. Mr. Mehta, I want to understand that, 3-year revenue CAGR is 21% since FY21 to 24, and PAT CAGR has been 38%. And you've said that you will be doing a double-digit growth. Can you help us quantify as to, by the end of FY25, what will the growth look like?
See, it will be difficult to quantify as of now what would be the growth like. But yes, since we have, as Mr. Prashant said, that our capacity is maxed out, but we'll be in the same range of around what we have grown in the years. So we will expecting around the same CAGR which we are doing it. So that's a double digit we are expecting in the growth front.
Right, and Mr. Garg, just to try and break this down a little bit better. So, does the export market allow you to grow better on your top line, given the fact that you'll probably get better realizations, better value for the product you're selling? And also, is it more margin accretive? So, does this leave scope for a margin upside maybe a couple of years from now?
So, export markets definitely help contribute in the bottom line better. Of course, now we need to also, in order to understand this better, there are 3 aspects to our business. One is welding consumables, second is wear parts, and third is heavy engineering. So, on the wear parts and heavy engineering, we feel the export markets offer better margins. So, definitely it helps contribute on the bottom line better. But we are again, seeing growth. The kind of sectors that we serve in, steel, cement, power, mining, engineering, railways, we see growth happening in India as well. So we are trying to capture markets outside of India as well as in India, and we are focused on both these initiatives. We're not just doing one at the cost of other. Also, it takes a little bit longer to get export markets. So therefore you can't do one at the expense of other or one at the cost of another.
Sure, point taken. Mr. Mehta, last off, with regard to return ratios, what's the kind of return ratio expectations you have? Because you've just done a fundraise of around 160 crore on a market cap which is roughly 800 odd crore. So where should your return ratios be at?
We will try to maintain our return ratios and improve it better in the years to come.
Okay, point taken. All right, with that completely out of time, with both of you, thank you so much. The management of Diffusion, of course, stock up 21%. So cheer especially for investors who've gotten an allocation in this particular IPO.